Hello there. I am Adam Gower. I'm going to shut down some of my screens here. Adam Gower, founder of Gower Crowd and host of the real estate reality show at youtube.com/Gower Crowd and on good podcasts everywhere. Welcome to this week's real estate reality show weekly news roundup with my guest, Dave Saxe, managing principal at Calvera Partners. Each week, we look at three of the top stories dominating the news cycle over the last week. And this week, we're going to be discussing, has the world really changed? Oh, and by the way, I'm going to put all the links to the articles that we look at on the show notes page at gowercrowd.com, the podcast page. You can see all the articles that we're talking about. You can read them for yourself and make some let us know what you think. But the three topics that we're going to go ahead and talk about today is, has the world really changed? In the sense that, has the use of real estate really changed? Second thing we're going to talk about is the commercial real estate crowdfunding world on the back foot, playing defense. And the third thing that we're going to attempt to tackle, right, Dave and I have been scratching our heads about this the whole week, US debt the US debt problem. Is this a slow-moving train wreck or a non-event? Now, before we get started, if you'd like to learn more about Gower Crowd and about Dave and Calvera Partners, or about real estate syndication in general or crowdfunding in general, just go to the podcast page at gowercrowd.com. While you're there, be sure to subscribe to our newsletter. It goes out every Wednesday. It's totally free. You can always unsubscribe. Dave, super good seeing you.
Good seeing you.
The first article that we're going to talk about that we had a look at this week, let's just spend a couple minutes. This is kind of like the minutes from last week's call when we talked about home ownership. And this idea that despite interest rates, there still seems to be prices are still going up for single family homes across the country. CNBC wrote an article, Why Many Homeowners Feel Trapped in Their Low Rate Mortgages. And they talk about golden handcuffs, I should say, golden handcuffs. So more on that. I mean, that's the real problem, isn't it?
Yeah, well, we used to use that term way back in the day when I worked in real estate private equity, in that you'd never start your own thing like we both have because of the golden handcuffs of the salaries you would get paid at those jobs. So similarly, in this case, whether it's myself, a lot of people in my network, we all got our sub 3% loans on our condos or homes, primarily in the Bay Area from First Republic Bank. At sub 3%. That is an asset. I cannot replace that. So I look at that as a real big benefit to being and staying in my home. And if I sold my home, tried to buy somewhere else, my interest rate could more than double. So That's why it's called golden handcuffs. And that's why you're not seeing as much on the for sale market, because people want to hold on to that for as long as possible.
It's kind of locking up the market. Anyway, that was an interesting article. CNBC.com put it out last week. Many homeowners feel trapped by low rate mortgages. That is the truth of what's going on. And I'm actually experiencing this. I'm looking for another house, and there's nothing out there. People asking really stupid prices. I don't know how they get away with it. Where I am, I think we talked about that last week as well. All right, so let's move on. It's kind of a similar theme, but a totally different topic, and that is, has the world, so this is we saw a few articles here. There's one in Reuters, commercial real estate investors, banks buckle up, perfect property storm. And then Forbes had an article, commercial real estate investors, urban doom loop. It's got to love this title. So the question here is, has the world really changed? Will people ever shop in malls again or work in offices the way they did before the pandemic? And the question that Reuters asks is, how safe are the fortunes that investors piled into bricks and mortar? Dave, what are your thoughts about that? Has the world really changed?
Well, I'm sitting here right now in downtown San Francisco in a high-rise office building, so I feel like I'm pretty qualified to talk about this. I'm still someone that likes to come into the office, be around the people, but what I'm noticing is things have changed. There's nobody here today. I'm exaggerating a little bit, but I can tell you firsthand in downtown, I'm seeing the 3-day quote unquote work week. It's not just folks like me that have their own business with more flexibility. It is dead today. It's often dead on Monday. So my personal opinion here is that there will still be a need for office, particularly high-end office spaces. You got to bring investors through. You got to have board meetings. That's not going away. I think young people like the socializing that happens. I did back in the day, but the amount of use of it is going to be less, and people are getting used to and loving the remote work. So I think I kind of see it shaking out.
So that's interesting. So that's the, but do you think, is this a permanent thing? Do you think, I mean, is this something that we're going to see, like the way that people live their lives has just fundamentally changed, and that people are migrating? It's the great migration as well, right? That we're talking about.
Yeah, I mean, a lot of my network, maybe yours, during the pandemic, as we all know, moved to all your Austins and your North Carolinas and your Nashvilles, and their companies are allowing them to work remote, or they have satellite offices there. I do think that there's going to be more flexibility, but it also varies by market. So downtown San Francisco is struggling because we're so heavily weighted with office buildings. We need the kind of investment that happened in New York after 9/11, where they put, I think, something like $20 billion into downtown to make it more mixed use, to bring more residential there, to give people a reason to go. We don't have that right now in downtown San Francisco. Other than me, maybe I'm a little nuts, there's no reason to come down here except to try and build some sense of having other people around when you're working.
Yes, and that actually ties into the idea that the only thing that's going to work is major expenditures, kind of government level expenditures, tax breaks to encourage people to come back. That actually dovetails into our very last question today, doesn't it? It's kind of this debt problem issue. How can you really continue to spend your way out of trouble? But what about the way that people shop as well? I mean, are huge, like, what is the downtown going to look like? I don't know, right? The way that offices are sitting vacant, and there's crime and homelessness, etc. I mean, is this a true fundamental shift to remote working, in the sense that you could still go to an office, right, Dave? But instead of going to an office, downtown San Francisco, where you got to battle with homelessness and crime, traffic and parking and smog and whatever else you got to deal with, you could be going downtown to a gorgeous little, kind of village type downtown in the middle of, America, and enjoying life in a very different way, and still working for a big company, or make, having a proper career, if you like.
Yeah, or when I'm down in Silicon Valley, Menlo Park, Palo Alto, and work from down there, to your exact point, it feels better down there. You don't have all the issues I see on my way into the office. But to go back to your question on what is this going to take, what does it look like? There's a lot of smart people that keep using San Francisco as an example, trying to figure out what will do it. And I think this is similar with malls, experiences. There's got to be a reason to go, live music. Do I think Mayor Breed's plan of converting the Westfield Mall that just went back to the bank in downtown San Francisco to all pickleball courts is realistic?
That's what I've been saying. I know, right?
I mean, in a utopian world, that it's an interesting, novel idea. I'd say the more bigger takeaway of that is, whether it's a soccer stadium or pickleball courts, it's the experiences that you're going to have that would have to bring people there. Otherwise, you're 100% correct. There's really no need to do it.
Well, that's what this Reuters article talks about. It says, with remote working now routine, the many office-based firms and consumers habitually shopping online. This is a big deal. Cities like London, LA, New York, and San Francisco bloated, I'm quoting, bloated with buildings local populations no longer want or need, and that this means that the values of city center skyscrapers and sprawling malls may take, and they actually take an optimistic view. Instead of saying may be wiped out, they say may take much longer to rebound. That's the issue, isn't it? Really?
I'm really worried about, particularly you mentioned these buildings. I mean, the Class B, lower quality downtown office space. I think you can make a case for the high end buildings for the reasons that I mentioned, but those really concern me. And there's a lot of that in these downtown metro areas. So I tend to agree with the articles there, and the ramifications for this are so important. You mentioned it's a clever, catchy term, these doom loops.
Right.
I get it. If people stop coming downtown and conferences don't come downtown to metros like whatever, San Francisco, Los Angeles, what you have is then the hotels start to empty. The municipalities aren't getting the same hotel and occupancy taxes. All of then you can't fund the different services in these downtown areas, and they continue to go on the decline along with the crime and the homelessness. It is a major issue, particularly in a handful of these markets like ours that are not built out for other reasons to come here.
And the other, actually, the interesting thing about the Reuters article was its focus on the impact on banks. US banks are revealing, they say, spiraling losses. And this is a wall of debt. So this is a banking problem as well. Even if it takes too long, you see a lot of banks failing as these properties, ticking time bomb they talk about.
There are office buildings already going back to the lender across the country, particularly in downtown areas. And we know from the GFC, Great Financial Crisis, that I don't think the lenders, I mean, your more aggressive, opportunistic lenders, there's this whole different story, but your generic lenders are not in the business of being landlords, particularly distressed office buildings. So we've had previous discussions about what they can do to potentially smooth out the distress, delay having to take those over, work with the landlords. But per what we just talked about, it is a massive problem, and I don't know how long you can kick the can down the road on some of these buildings, for example.
Yeah, and this is actually Forbes talks about the same thing. It's another article in Forbes, same topic. Commercial real estate, they talk about the doom loop is both crisis and opportunity. And their opening line is, commercial real estate investors face a lot of headwinds, remote work emptying downtown offices, ravaging inflation, rising interest rates, shrinking family sizes, but they may not even be accounting for the great migration, right? This is people actually leaving the city. There's even more to be concerned about than really hits the headlines with these assets.
Well, my first job in real estate was working for Sam Zell at Equity Office, and I will say these are the days when, while there's issues with all product types, office concerns me for sure.
All right, let's move on to our next topic today, and that's the idea of the world that I have built everything on for the last few years is the world of commercial real estate. Actually, it's a misnomer. Crowdfunding. It's not actually crowdfunding. It's online syndication. The idea that you can syndicate your deals online, and with the recent news, particularly from CrowdStreet and their issues with Nightingale, we were discreet enough not to mention names in our first couple, but I don't think we can get away with that anymore. It's a major problem, and the commercial real estate crowdfunding industry, right? The platforms have been on the back foot playing defense, right? There was this email that went out, I think, from Realty Mogul. They listed. They felt the need to list how they protect their investors' capital, as though they don't always do that, right? Basically, but it's right.
Absolutely. Oh man, and you are such an expert on all of these different companies and have studied them, so know this really, really well. And to your point, the whole concept of crowdfunding now, it's not just your CrowdStreets and your Realty Moguls, but due to 506C, which I can go into another time, but the ability to more broadly market to investors offerings. It's not just those companies anymore. A lot of folks have broadly pitched the ability to crowdfund from accredited and non-accredited investors. So absolutely. I mean, Realty Mogul, I got that email as well. They went line by line and kind of point by point, I think countering somewhat the issues that CrowdStreet had to try and
Well, the
show how
negative
they're
press, exactly right.
different. You look at, and then you saw CrowdStreet, they did a press release in the last week or so addressing how they're changing and what they're implementing, and their CEO is out. They've done an amazing job growing and making crowdfunding in the forefront. But what always has concerned me about them and others, and it's gotten better, but clearly not good enough, is these are tech companies at the end of the day, and they need to scale as fast as possible to make their venture capitalists happy. When you have a company, when you have an industry like real estate that's very complicated, that's highly regulated, that can swing and have cycles, you're dealing with high net worth money, you're dealing with complicated legal documents and filings and regulations. You cannot not have systems in place that protect you and your investors, because in a worst case scenario, oh my goodness, what's happened here, even if it was just one or two, that's still too many of some inexcusable things that happen with investor capital.
You know, it's interesting that you say that, it's actually the capital that drives the decisions and the need to grow quickly. You know, there's this, I'm trying to keep my train of thought on target here, right? But it's the idea of growing quickly. It's this book by Robert Ringer. Have you ever read it? It was written in the 1970s. He was a real estate broker in San Diego, and his book is called Winning Through Intimidation. That doesn't mean winning by intimidating people. It means winning despite all these, you know, superstars who are trying to intimidate you, right? So that's his whole thesis, is how to win despite being intimidated by the old guys. And one of the things that he talks about is real estate sponsors is very cynical. Real estate developers will build an apartment building, he says, in the Sinai Desert, right? Basically, where there is nobody, if investors will finance them to do it, right? That's his idea. It's like, don't be the tail that's wagging the dog. And that is this idea that, you know, the money that has backed up, you brought up, right? This money that's backed up some of these platforms has been the driving force in the way that they've moved forwards as fast as they have. In fact, it's what crushed realty shares.
Yes.
Realty shares, the exact same thing happened. Now, I don't know if that is what's behind, you know, CrowdStreet's rise, where they're being pushed to expand too quickly. But the point is that whatever's happening today, apart, of course, from any kind of fraud or something you simply cannot predict, is predictable. This is the first time since 2012, since it's been legal, that there's been a downturn, right?
Yes.
It's like being at Vegas and winning on red all the time. Eventually, if you're doubling down every time, you're going to lose.
Real, you know, and a real quick point on that, because I've had conversations with all of the companies going back many, many years here, just talking to them casually about what deals they put on their platform. Would they be interested in any of ours? You know, and it was pretty evident to me, again, I think they've cleaned up some of this, but early on, the highest IRR deals that they were the ones that they wanted. And it didn't really matter if those were in, I'm exaggerating, but, you know, kind of the middle of nowhere versus a core deal in Silicon Valley that could be multifamily that might not show the same IRR, but is a much safer investment. And it's because the projected IRR with normal assumptions didn't pop in an email.
Well, that's the thing, you see, but the lessons that they learned was that if we want to raise money for deals on the platform, we have noticed that investors congregate or whatever, right? They gather around the higher IRRs. There was a positive relationship between, this was in the early days, I know, because I interviewed all of the platforms for my first book, right? Leaders of the Crowd. But they noticed that the higher the IRR, there was positive correlation between the IRR and how many people showed up for a webinar.
And more directly, when I would have these conversations with them to back up what you're saying with a real example, I was told your IRR is not high enough. Come back with a deal that was more in an obscure neighborhood of the Bay Area. This wasn't even that long ago, with a higher IRR, and that's going to appeal more to our investors. That freaked me out.
It's not good. Yeah. It's in fact, I'm surprised they say go and find a crappier neighborhood, but
they didn't say it that way, but that was the
implication.
You're going to find a higher projected IRR, you're going to take on more risk.
Yes. Or the other thing that you can do to get there is to just pull your projected exit back a year, right? So we can get out. All right. So instead of modeling for 5 years, we'll model for 4. And suddenly we added, 20% to the IRR, another 400 basis points. And now we're, qualified to list. But when you start playing those kinds of shenanigans, you cannot, that is a runway that is going to come to a precipice eventually.
To your point, by the way, on that, you said, and it's true, when I was writing our quarterly newsletter with my business partners and we were writing it, I never had to discuss in the history of my company till this last cycle, apartment rents going down. So that just shows when things are going up like this, you're not going to notice the issues that you have until the music stops and you reach how always happens in real estate, a cycle.
This is something that I've actually called the crowdfunding paradox. Crowdfunding paradox. And the paradox, I actually came up with this term some years ago, is that when you come out of a downturn like the global financial crisis, you start to see much higher projected IRRs because there's an expectation that there's higher risk, the fewer people in the market, the deals are distressed. So you've got to compensate for that downturn, end of cycle downturn risk with bigger risks and higher IRRs. But as the cycle extends through a bull period, a bull market, the longer it goes, those returns get smaller and smaller and smaller, right? You simply cannot, because there's more competitors, prices have gone up. You simply so projected returns come down. With crowdfunding, this, and you said it, this incentive from the platforms, no, you got to have a higher IRR, otherwise no one will invest. That is paradoxical to what really happens. That is the crowdfunding paradox. And that's in part maybe what's really driven some of these problems.
100%. And by the way, not just a higher IRR, I was told a higher cash yield, because you have to have the higher cash yield so the crowdfunding sites can earn their fees. Otherwise, there's no room.
Yeah, exactly. That's right. I mean, that comes out of investors' pockets as well. Anyway, so it's going to be interesting. I don't know how deep I want to get into the Erwin Stein article. LawEconomicsCapital.com wrote a very interesting article. CrowdStreet fooled me twice. I'll put it in the notes, and you can take a look at that. But he wrote a scathing indictment of what's been going on, and that these are mistakes that were identified early in the cycle that should have been rectified that never were.
Always work with a trusted sponsor is the message.
Work with a trust. But even that, but Dave, even then, no one could have faulted CrowdStreet for having invested with worked with Nightingale. There was no red flags.
I didn't mean to, I accidentally misspoke there. When I say trusted sponsor, they absolutely vetted them and got letters of recommendation from. What I meant more was investing with people that have all the safeguards in place to protect investors, making sure the regulatory, the legal, all that stuff is taken care of.
And that's quite a lengthy process to do that. Mm-hmm. There are some.
It's not fun, but it's very necessary.
Yeah, exactly. All right. So that's our second topic, our last topic of today. With only a few minutes left. Here we are on Facebook and not YouTube. I'm going to have to apologize to everybody I told. I don't know what happened with YouTube. We'll figure it out. The US debt problem. Here we are, you and I, world experts on the US debt. So the question is, and we've read a lot, but this is I think this is typical of everybody. Most 99% of people don't really understand this, right? Self-included, but let's talk about it anyway. The US debt problem. Is it a slow-moving train wreck or a total non-issue? There's an amazing article in the Wall Street Journal. It's called "The America's Fiscal Time Bomb Ticks Even Louder," and they talk about a Grey Rhino. So the Grey Rhino effect is different from a black swan event that just goes boom. And suddenly it's like the world. A Grey Rhino is something that is galloping towards you with intent, and it's so far away you don't pay any attention until it's on top of you. So what's going on? What is the deal with the with the debt?
Yeah, again, there's a lot of people smarter than I'm an econ major, but there's a lot of people smarter than me talking about this all over the press and on TV. But the general theme here is, at some point, is the United States not going to be able to take care of its debt and pay off its debt? And at that point, what's going to happen both to the United States and the world's economies? To your point, some people, very smart people who think about this all day long, economists, financial markets experts, are saying it's a non-issue. The United States is the United States. We're the safest municipality, nation in the country. We're always going to be fine. This isn't an issue, et cetera, et cetera. Others, which is this whole issue with the Fitch rating agency that downgraded the U.S., they're saying that due to the political environment where Democrats and Republicans are drawing hard lines in the sand here, that I'm of the cynical belief that this is all political show, and they all come into an agreement at the last second, and we solve it, and we raise what's called the debt ceiling. Look, I mean, in today's crazy political environment, could I see a scenario maybe where they don't resolve it because there's some crazy politicians in there, even though they would torpedo the world economy? Yes, but most people I've been reading about are saying, oh, that's never going to happen.
Well, hang on. Now you talk, but wait, so let me just interrupt, because now you're talking about the debt ceiling, which is a different matter. The debt ceiling is how much debt you bring on. I actually read a very interesting. I'll see if I can dig it out. I should put it back in the notes. I haven't got it on my screen here, but a very interesting article that explained the U.S. debt and how it works, and really compared it very much to individuals and how individuals take on debt. It's all kinds of different kinds of debt, right? You take on a mortgage, you have credit cards, you buy a car, you borrow for that. The same with the US economy, borrows money in order to pay for the services that it has to deliver to its citizens, that is beyond the revenue that the country yields from taxes. So there's this swings and roundabouts really with how much can you tax versus how do you reduce taxes and reduce spending, or do you increase taxes and generate more? The issue today is that because the debt ceiling is now, I forget the number, it's like 31 trillion. Some mind-boggling. I worked out, if you earned $1 million, I forget the number. If you earned $1 million in an hour, I forget the exact numbers, I should look it up. It would take you 3 weeks to earn $1 billion and 400 years to earn $1 trillion. Just to put it into perspective. And our debt problem is 31 trillion. The issue is not the ceiling. The issue is the debt service on that money. And it's starting to eat up more and more of the revenues that the government has. And the only way to feed that is to print more money.
That's what some of the folks have been saying is, oh, we can always we'll never actually have this problem. We can just keep printing money. We're the United States. But then we know that leads to other inflation issues, all sorts of different things that these articles.
Well, eventually it comes to the end of the line. If you compare it back to individuals, I remember when I was first in America, somebody giving me really, really wise advice. He said, taking tongue out of cheek, that all you need to do with your credit cards, if you rack them up and max them out, is get another credit card and pay that one off with this.
Yes. Welcome to America.
But that's kind of the point, right? You just keep borrowing more to pay the debt. It's like a Ponzi scheme. Eventually, this house of cards comes down. And that's the idea. You have these people that think this is ultimately apocalyptic. And then those that think, don't worry, we'll just print more money.
Absolutely. But to bring this back to commercial real estate, and we were talking about this a little bit, I was thinking about, it's clearly a very different issue. But, as you see these higher temperatures around the U.S. and you start to wonder at what point in some of these markets, is climate change, increasing temperatures, infrastructure around that, running out of water, et cetera. Wherever you fall on that, how do you put that into your pro forma when you're valuing a building? And it really depends on how quickly you think that's going to be an issue.
Right.
If you think either of these issues is going to be a problem in the next 3 to 5 years, and you have a 3 to 5 year hold period, well, you got to start thinking about how to consider that when you're making your investments.
Well, that's the point, isn't it? That's why it's one of those issues that we're brave enough to tackle on this first live broadcast that we're doing, that most people just ignore. Because why? Look, if the US does default on its payments, we're going to have to worry about a lot more than the pro formas. You know what I mean? We've got lawyers, guns, and money. That's all we'll need if that happens, right? Warren Zevon, to quote a song.
Yeah, I'm just sitting here in my commercial real estate bubble.
What's that?
I'm sitting here in my commercial real estate bubble looking for deals. But at the end of the day, you're 100% correct. Everyone and everything will have an issue if this becomes a problem.
It would be a very, very different world.
Yes.
Exactly. Well, Dave, thanks very much. It's been a pleasure talking to you. We've come to the end of our time, so we've covered 3 topics. We even opened with a third kind of minutes based on last one. We managed not to go live on YouTube. I'll have to apologize to everyone. We were live on Facebook. So thank you if you have joined us. I have no idea what's going on. It's the first time we've done it. I've got no idea. I tried to get onto my Facebook page, but I was afraid that if I did that, I'd blow something up. Oh, look. What's going on here? Oh, yes, it is actually playing it. So if anyone,
that's good.
Yeah, if you actually want to make a comment, please pop it in there so I can see that there is somebody over there. But we'll be back next week, and all being well, we'll be back live on YouTube. If you want to learn more about Dave over here in Calvera Partners, or about commercial real estate investing and syndication in general, go to gowercrowd.com. Look at the podcast page for these live broadcasts. As there's a nice bio on Dave there, some links to his website. And while you're there, of course, be sure to subscribe to our newsletter. You're going to get information. And of course, sometimes we'll get it wrong. I'll tell you we're going live on YouTube when we are not actually going live on YouTube. But anyway, you can always unsubscribe. Dave Saxe, Calvera Partners, always good to see you. Thanks so much for your time today.
Thank you.